This is Market Pulse by Faster Forward from Northern Trust Asset Servicing, the podcast where experts share their insights on current trends in the markets and financial landscape. My name is Nadia Cobalovic. I'm the co-COO of Hedge Fund Services at Northern Trust. I'm very excited to be serving as the host for today's episode. Joining me is Grant Johnsey, Head of Client Solutions, Banking and Markets, Americas at Northern Trust. Grant, we're back. Thanks for joining me again. I'm really excited to be doing this together.
Same here.
So as we've moved into September, I personally feel like we've been in a bit of a roller coaster ride in the markets. Can you tell me a little bit about how you're feeling and where we are and the September effect and where you think we'll go?
So this is the September effect is a bit of a statistical anomaly in the U.S. equity market, where historically September is over the last roughly 100 years, the only month that is net negative over time. There's been a number of reasons proposed as to why. A lot of people feel that as investors come back from the summer vacations, they rebalance their portfolios, but nothing's ever been concretely demonstrated as to what might cause that weakness. I don't put a lot of stock into the September effect, and the reason being is there's a couple of really bad months in there. September of 2008 would be a good example that have driven the overall return series down in the month of September. Historically, there were a couple of really bad Septembers during the Great Depression, for example, in the stock market. If you actually look at Septembers that are better, than zero or worse than zero performance, it's almost a flip of a coin. I've seen a couple of different stats, but let's call it almost 50-50 if September is going to be a good or bad month. When it's a bad month, it can be a really bad month, and that's what's kind of driven the overall return series for September negative, and that's thus the September effect. In this environment, I'm looking at some other factors other than the September effect that I think are going to drive the market.
What are some of those factors?
Well, I was trying to get a sense of, and we've talked a lot about this in prior podcasts, of what's the sentiment in the market. Because at the end of the day, the market in the short and intermediate time period is more of a voting machine. There's a lot of emotions and sentiment that are expressed. And trying to understand that sentiment is the number one goal that I try to have at any point in the market to convey to our clients. And right now, we're in a strong bull cycle. And we've been in that bull cycle for really coming up in a year. It started in October of last year, and it has momentum. There's positive bullish sentiment continuing, and so that's the ultimate undercurrent right now in the market, is one of a strong bullish trend, at least for right now.
Can you elaborate a little bit on why you think we're in that bull market or what's contributing, especially as you look at August and the sell-off that we saw in August? How long will that bull market continue?
Yeah.
And what are the trends that you're looking at?
So great question in August. I'll get to that in a sec. When I look at a bull or bear market, I don't always look at charts. I'm not a chartist. I don't put a lot of stock in the technicals. What I really look at is investor behavior. I think that's a better sign for sentiment. So I'll give you a couple of examples right now. In July, we had very strong sector performances that deviated. So low sector correlation, meaning that sectors were performing very differently from one another. That's a very good sign of a bullish market. What that means is that investors right now are being thoughtful of their money. They're looking at where to put money between different sectors, are differentiating, and that's a positive. That's a rational sign that people are approaching the market very thoughtfully and are looking for different investment opportunities throughout the stock market, at least in the United States. Conversely, when you have the end of a bull market, when there's a lot of euphoria, people are just buying everything. Everything's going up, and you end up, with bubbles and extremes in pricing, which sort of are, the end of a bull cycle. So we're not seeing that in those instances. Sector correlations tend to go very high, approaching 1. And then they get very high, sector correlations go very high in the bear market. For example, in March of 2020, sector correlations hit 0.99, so it's almost perfect correlation. Bids were being pulled, everybody was selling everything that wasn't nailed down in 2020, and so you saw sector correlations go very, very high. So low correlation between sectors is a very bullish sign. We talk a lot about the individual investor sentiment, and individual investor sentiment right now is positive. The bull-bear survey that's done by the American Association of Individual Investors right now, which comes out weekly. Anyone can go look at it on the AAII website. The difference between the survey of those investors that are bullish versus bearish is north of 20% and has been for a while. And almost all the returns, positive returns in the S&P 500 the last, call it 5 to 10 years, have almost all happened when that sentiment's above 20%. The number of surveyed bulls is 20% higher than the bears of individual investors. So those are a couple of factors. I look at credit spreads. Credit spreads have been coming in all year. They're very tight right now. Again, another bullish sign when investors are buying aggressively corporate bonds, so bullish sign. And another interesting bullish sign right now I'm seeing is we, in the last week, have hit 52-week lows on yields really pretty much across the curve. 2s, 5s, 10s, 20s are all at 52-week lows right now as the bond market has rallied and people anticipate rate cuts. That's a very bullish sign historically for the stock market, as well as you would most listeners would obviously draw that conclusion when rates go down. So all very bullish signs, and what that means is that in order to knock this bull off, it's going to take something fairly monumental, not just kind of a weak earnings announcement or a weak labor market stat that we saw in August.
Could you talk a little bit more about the sell-off in August, and might that potentially be a sign of a weakening bull market?
So in August, just to recap there, hopefully people remember this because at the time it was a little scary, or it seemed scary. We had about a 7-8% sell-off in the S&P 500 at the end of July and into early August. I think it bottomed out that first week. VIX, right, a measure of volatility, spiked all the way up to 65 pre-open on Monday, August 5th. And that was a reaction, or at least people thought it was a reaction to some labor data that signaled some softening and maybe an oncoming recession. But actually what happened, it started in July. There's a trade that a lot of investors have been participating in called the dispersion trade. And essentially the way a lot of investors have been profiting quite nicely off of the Mag 7 run-up is by going long Mag 7 using options, particularly by buying calls. And then they will offset that by selling the index, in this case the S&P 500, again, by selling calls is the simplest way to do it. Most of these were delta hedge, delta neutral, which means that they had a underlying equity position in these. And so they're really profiting off of the fact that the volatility of the Mag 7 names was a lot higher than the volatility S&P 500. So essentially they're long the volatility of Mag 7 and they were short the market volatility, the overall index. And that trade worked really well for a while. You go from roughly February of 2023 until July of this year of 24 with not one day in the S&P 500 with a 2% plus or minus move. So you could sell S&P 5 volatility all day, go long the Mag 7 vol, plus you get the pop of the Mag 7 doing quite well. And it's a nice trade because various times the Mag 7 represented roughly 25% of S&P 500 market cap. At the options expiry in July, which is I think the 19th, a lot of those calls were not rolled forward. And in fact, you and I talked about at our last podcast the Goldman report, is AI really going to take off and is it too early? A lot of investors, maybe not just that report, but just the fear that trade was getting so big and these stocks were getting so expensive relative to the market, people started to back out of that long Mag 7 using options and short the market. And so what happens, there's a connection between the option market and the cash equity market. Because when you go buy a call, for example, if you're buying an NVIDIA call, right, there's someone on the other side of that who is most likely a liquidity provider. Could be a hedge fund. More likely it's a market maker on the other side. About 85%, according to our options desk, of listed options trading in the U.S. is got a market maker or liquidity provider on the other side. They have to hedge themselves. So they'll end up buying, if you're buying an NVIDIA call, they'll have to go long NVIDIA or have some hedge that's long NVIDIA, and that then pushes up NVIDIA's price in the market. So when you have those calls that are not rolled, and were not rolled in the end of July, you've got now people trying to sell down to flatten out whatever their risk was behind it. So that started the first grains in the sort of tech sell-off that we saw and the peaking of the Mag 7. Now, you've got a lot of people who are in that trade. Not all of them exited it in July 19th, that they saw the that trade start to fade. A lot of people were also using the yen carry trade to finance that. So it's no surprise you had a lot of volatility in Japan at the same time because they were borrowing in Japan where you had essentially zero interest rates to lever up on this. So when that trade started to fade, you actually had quite a few investors that got called into this. So the VIX hit 65 in the morning of August the 5th. The market was down on that day just a few percent, and over that time period, like I said, I don't know, it's down 7 or 8%. The last time VIX hit 65, the market was down 30% in March of 2020. So the reason it went so high wasn't because really people were that worried about the economy, because a couple people got caught short market vol when they needed a cover. Market knew it, and they had to pay their way out of it. That's why VIX fell back very quickly. Now, here's the interesting fact on this. At the time this trade started, at the time that the market broke down, this trade started to break down in late July. The S&P 500 was over its 550 and 100-day moving average. All right, the call put ratio, right, went from heavy calls because people were long this to heavy puts. That ratio reversed. And when that has happened historically, when there's really strong momentum in the market, again, a lot of bullish signs here, and all of a sudden the call put ratio reverses to focus in on a lot more put trading and buying, which again, bearish sign. When that happens like this, what ends up happening is the market 3, 6, 9, 12 months down the road, historically 85 to 90% of the time is higher. And the reason being is those sometimes signals like the labor market weakening, people react to on top of this trade unwinding. There was a bit of fear at the beginning of August, as you may recall. But the reality of it is, it really wasn't enough that, hey, all right, so unemployment went from 3.8 to 4.2 or 3 at the time, right? It's not enough that all of a sudden you need to run for the hills, batten the hatches, and get ready for a major depression or recession. The market realized that things resumed to normal. Again, all very good bullish signs, but that's what happened. It really came down to this dispersion trade where people were trying to profit on the differences in volatility and market movement between Mag 7 and S&P 5 that broke down in July. And that was the driver. It really wasn't driven, at least at the outset, by concerns of a recession. And what's happened since then, we've seen is strong bull market activity following that.
Do you think any of that was related to the trade just being crowded or overcrowded?
Oh, absolutely. It was overcrowded. People were worried about it, working against them. You have a couple of drops of sand, and all of a sudden you've got
it all just moves.
At that point, exactly, you have the avalanche of people rushing to the exits. And that's why if you go back to August 5th and you look at VIX, you'll see this very clearly. The 65 VIX number was hit pre-open. And then as soon as the market opened up to 35, and then by the end of the week, I think it was by the end of that week, even at 20 or below. So once all of those trades kind of got out, a couple traders got caught sideways in that. Once they righted their risk, portfolio, then, the market kind of went back into this thing. And again, very healthy sign that you have seen good breadth since then. The fact that NVIDIA had a quote unquote bad or poorly received earnings in the midst of this in the last few weeks, and the market didn't completely, sell off. Actually, it was up the day that NVIDIA came out and had bad earnings and sold off. Great bullish signs. And again, that's where I come back and go, we've got a pretty strong bull market right now. Not to say it can't be knocked off, but it's a nice undercurrent of bull market coming into the election season.
So let's talk a little bit about the Fed and interest rates. So the labor market report was weaker than expected. Based on the CPI report, seems like inflation may be tamed. And the Fed is generally celebrating kind of taming inflation, we think. Do you think that we are kind of in the clear in terms of some of the inflationary pressures we were seeing? And where do you see things going in terms of rates?
So, right, inflation, the report came out, CPI is 2.5%, which was kind of in line with everybody's expectations. And the Fed seems to be doing a little bit of a victory lap that they were able to tame inflation and not have the economy implode. I think the battle is still needs to be fought. You've got two presidential candidates that are populist spenders. They are going to probably spend more money. Fiscal spending is a stimulant to the market and certainly inflationary. And you've got a lot of other inflationary factors, demographics, onshoring and friendshoring. All these, commodity prices are probably poised to go up here as we have to rethink commodity supply chains. So all of these things mean that there is going to continue to be an undercurrent of inflationary pressures, which is different than the last roughly 15 years that we've had. So I don't think the fight's over. There's some comments made by the Fed recently that if you read them, it doesn't seem that there's great, a unanimous decision on the Fed that all the governors think that the fight against inflation is over. So I think there's still a lot left to go, and I think you might see inflation pick back up in 2025, especially post-presidential election, and when whoever gets elected starts whatever populist policies, raising tariffs, inflationary, right? Onshoring more of our manufacturing is probably going to be inflationary. So whichever candidate we get, I think you may see some inflationary headwinds pick back up.
So a little too early to do any victory laps on inflation?
I think so.
Okay. So you and I have talked about this in the past a little bit around just where the Fed is in terms of treasuries and where treasuries are pricing. Can you talk a little bit about that and where you see treasury yields in terms of interest rates and the actions that the Fed has taken?
Yeah, what most folks don't realize right now is that the Fed, the Federal Reserve, and the Treasury Department are on different pages. So the Treasury Department right now is actually overemphasizing the short end of the curve. They believe that interest rates are coming down as the market does, and they are actively right now buying back in billions of dollars bonds that are, these are probably 10, 15 years out. I see them buying a lot of 2040s, 2042s, treasuries bonds that they have issued. They're buying those bonds back. They have a coupon of 1.5 to 2% on average. So they're paying out pretty low interest rates. And you might scratch your head and go, why is the Treasury Department buying back these bonds they're only paying 1.5 to 2% interest on, and then reissuing those with Treasury bills on the short end that right now that's 4.5, 5% market depending on where you are in the curve. And the reason being is they are trying to get ready to use some of the lower interest rates to try to get their overall costs down. Mm-hmm. In doing so, they're actually stimulating the economy, and if they continue to buy back bonds on the lower end of the curve, or the longer end of the curve, they're providing liquidity, right? They're in essence helping lower those rates because they're buying those bonds. And you might see, and this is actually what's been happening, you're going to see the long end of the curve fall a lot. Well, that's inflationary. That means companies can borrow lower because the Treasury curve goes lower, and that's the kind of the opposite of what the Fed wants. So it's interesting to see how this plays out. The Treasury Department is continuing, at least the beginning of this month, to buy those bonds, and we are issuing a tremendous amount of T-bills right now that they eventually want to term out, but they want to do that, I believe, when the overall yield curve falls across the curve.
So you mentioned the elections, the U.S. elections. The last time that we spoke, we were in a very different place. Biden had just bowed out of the elections. The markets were pricing for a Trump win. Can you just talk a little bit about what you're seeing in equity markets this election cycle in the U.S. versus maybe what we've seen in previous election cycles?
There are probably three big differences this year from prior years. So historically in an election season, a presidential election season in the United States, the investors tend to fade the equity market, meaning they tend to kind of stay out of it and don't put a lot of money into equities. That tends to reverse in roughly mid-October. Investors have favored treasuries, and they have generally favored treasuries over corporate bonds until right around the election, call it this time of year. This year's been a little different. We've seen pretty heavy buying in equities almost the entire year with a couple of dips here and there. The credit market has actually continued to take in money, and credit spreads during the course of the year, again, with a couple of little blips, have continued to tighten. So there's a lot of buying and interest in investment grade in particular, but even high yield bonds. And the other thing that typically happens is volatility starts to pick up before the election. And we're seeing that. So that is happening, but the anticipation of volatility this year is higher than it has been in prior election seasons. So what's a little bit unusual this year is a very strong equity market headed in the election, one of the strongest. I think it's number one or number two in terms of presidential election years, the return on equities. It's one or two strongest years leading up to at least this point in September to our presidential election. Treasuries are actually starting to fade a little bit right now. More money is flowing across institutional and retail into corporate bonds than there are treasuries. So the cycle this year kind of rhymes with prior years, but with a couple of differences. What's really interesting, a couple of things I would encourage investors to think about is the bond market. The bond market historically, and I'm talking really the Treasury market and then everything else by proxy because everything's a spread off of Treasuries. The Treasury market gets really volatile historically about a week before the presidential election and stays till about a week after we know who the candidate, which one won, which could be a couple of weeks later this year.
Who knows?
So the one thing, who knows is right. So the one thing I encourage our clients, investors to do is to make sure if you've got a view on the fixed income space, you want to have those views, I believe, expressed about a week before the election so that you can avoid that volatility. And then, hey, if the volatility works in your favor and you want a dollar cost average, you can. But I do expect there to be a bit of volatility in the Treasury market starting about a week in advance. Another interesting trend is historically in mid-October, is when equities actually start to take off. And this also coincides with the bull market backdrop we have. The end of the year after presidential election is very, very strong, typically for equities at least. And you'll also oftentimes see after we know which president is some dispersion and deviation between these sectors again. Mm-hmm. So depending on the policies of the candidate where investors think they might favor, say, energy stocks where they're maybe more pro-oil or maybe favor more tech stocks where perhaps they're trying to put some barriers to protect our companies with tariffs, et cetera, you might see that play out. So that's the other thing I would encourage investors to think about is depending on which candidate looks to be winning, they might think about where those sector dispersions might come post-election. But historically, it's usually the end of the election year. It's pretty good for equity markets.
Right. I know that speaking of investors, you recently did a webinar for some of our asset owner clients. Curious if any interesting kind of questions came out of that or anything worth sharing for this audience that those clients may be thinking about, concerned about, excited about, right? Any of the above.
A lot of questions on volatility in the fixed income space. So we talked about that. I think one other area that came up a lot is geopolitical risk. There is very little discounting right now of geopolitical risk in the equity or energy market. I mean, there's almost nothing implied in the price of oil, for example. So that was a couple questions that we had as well. And I think there's a lot of fear on what the equity market's going to do in terms of volatility. Again, I feel better than I have in prior elections because we do have signs that there is positive sentiment in the market. And actually, you're seeing this play out in other equity markets as well. There's an undercurrent. I mean, most equity markets right now across the world have been performing reasonably well. And I think that's a good backdrop. But there's definitely, like from here until at least mid-October and probably into November, there's going to be some chop. And we're seeing that. There's going to be a lot more volatility, I think, right now as people try to figure out where's the election going, where are some of these geopolitical conflicts headed. So I do think you're going to see some chop. And it's not surprising that VIX, which is obviously a measure of volatility that we've talked about, is going to peak as well. And investors have been, VIX peaked for October option expiry very early this year, more so than prior years. So the market is already expecting volatility, and I think that's a positive sign, actually. Again, a nice rational sign from the market when people are anticipating volatility in what's already been a pretty volatile election season and geopolitical environment. So good signs of investors being thoughtful and rational with their money.
To the point of geopolitical risk, so this is something that I haven't seen covered much, but I am curious to get your thoughts and kind of where you see things going. So Turkey recently applied to join BRICS, and allegedly that's coming off of frustration of not having joined the EU. I'm curious if you see any correlation there or any threat there in terms of geopolitical risk in the markets and further just polarization within the global environment.
It's a point that you're right. Not many people are thinking about or talking about because it's a little bit of a weakness in the EU, NATO facade, right? That hey, there's some dissension there. There's not just Turkey. Look at Hungary is another good example of that. Yes, it is a sign of the polarization that we are continuing to face. And again, another reason that I think when you have two economic systems that are going to be competing against one another, why we are due for more inflation. I think bigger picture, and we talked about this some with energy in the May podcast, there is a lot of work that China in particular is doing to rally other emerging countries, not just Turkey, obviously, but a lot of countries in Africa and South America. I mean, the Chinese, this is another thing I've been talking about right now, they're on pace to be doing some military exercises with Brazil, not that far from the United States.
Also a member of BRICS.
Yes. So, that's what China's trying to do. They are trying to pivot away from the exposure they have to the West, right, which has been one of their huge export destinations, and to the rest of the world. Now, here's what's fascinating about it. China right now is running between a $90 and $100 billion trade surplus. Okay, that's the biggest surplus we've ever. That's bigger than any other exporting country historically we've ever seen. It's monthly, 100 billion, 90 to 100 billion trade surplus per month. Right, they're exporting more now to these non-Western countries, or around roughly half. They're one of the largest car exporters now. They are really trying to create a polarized world where they can decouple not just from the West, but the other thing they're trying to decouple from is the dollar. They are de-dollarizing right now. It's one of the reasons that gold has been going up. Another interesting factor about this that most listeners don't probably realize, because everyone hears about how bad the Chinese market is. And look, their equity market has sold off big time because of the real estate crisis. But one of the best performing asset classes in the world right now are Chinese bonds. And the Chinese currency is actually doing pretty well. And the reason for that is if you want to de-dollarize, if you want to get away from using the dollar as your reserve currency, you're going to need a couple of things to do that. You need a strong currency, or at least a stable currency. It's one reason that crypto and Bitcoin aren't being used for trading, is because they're way too volatile for people to have in their own reserve and use that as a means of exchange. You also need a strong bond market. And the reason that you have to have those two elements is if you've got a country that's trading with you and they're trading with you in your currency, so in this case the renminbi, and China, they're going to hold some of that currency just for working capital, right? They're buying and selling goods from you all the time. So they need to have a stable currency. They're not going to hold that currency if it's whipsawing up and down. And they also need a place to invest that currency while they're sitting at working capital, and they want a strong bond market. So Chinese bond market is actually, Chinese bond market, gold, and the Dow Jones Industrial are the three assets right now that are at all-time highs. And I really want to underscore that, because that's what's going on with gold. The reason China's been a huge buyer of gold, and they have moderated a little bit as they work through the real estate crisis, but they're still net buyers of gold, is they need something in reserve to support their own currency. And what else do you have? You don't use other people's currencies. You're not using crypto, so gold's the go-to. And I think you're going to continue to see them and other emerging markets that want to de-dollarize buy gold. This whole thing started in roughly March of 2022 when the Ukraine invasion happened. The United States and the West froze Russia out of the Western banking system and the dollar. China saw it and said, it was probably inevitable for them to do it anyways, but said we really need to de-dollarize because we can't have that happen to us if we get in conflict. And so that's what they've been doing. They've been de-dollarizing, and they're now pulling away allies like Turkey into their sphere. And they've got great natural resources to leverage. They've got a huge trade surplus to leverage. And I think they're going to see more people who will trade with them directly and not on USD terms.
It was definitely something to look for.
Indeed.
So just to bring it back to something that is near and dear to my heart, hedge funds and markets, near and dear to your heart, there was a recent article in Institutional Investor, an interview actually, with a hedge fund founder, $100 billion plus fund, and he talked about a couple of things, two things that stuck out to me. One was that his Peloton trade did not go well for him, but also that his Peloton has become a coat rack, which broke my heart because I'm still a big fan of the Peloton. And this is not an endorsement to buy or sell Peloton. I'm just saying I was destroyed that it's a coat rack. I will not give it up. But the other interesting part in the interview was he talked a lot about this hypothesis that he has around markets actually behaving very inefficiently, especially in the comparison over the last 30 years. And not to date us, but we may or may not have started our careers in and around that time frame in this industry. So I'm really curious to get your thoughts on just market behavior and market efficiency. And do you think markets are behaving efficiently, or do you think that view kind of holds any water? And part of what he attributed it to, interestingly enough, was technology and the emergence of social media.
Interesting. Huh. I haven't seen that yet. I think that's fascinating. I've always believed, and I said this at the outset, that the markets are more of a voting machine in the short term. From a execution standpoint, markets are definitely more efficient in terms of being able to, at least the equity markets, and even the bond and FX markets, I would argue, but certainly the equity markets in the developed world are much more efficient from an execution standpoint. Spreads are tighter, market impacts lower, transparency is better than it's ever been. From a price movement standpoint, it's interesting because I have to look at that report in more detail. But you do see, look at the meme stocks, right, and how social media impacted that, and how even the regulators couldn't do much about it, right? Even though there was definitely a, pumping up of stocks very visibly on social media by, various players like Roaring Kitty. Mm-hmm. So there's definitely that element. What I think also drives it, and I don't know what was all in the paper, I'm curious if there's other elements that were mentioned as theories. I feel like the amount of retail investors that are in the market and are trading, it's also, I think something like 70% of households have direct exposure into the equity market in the United States nowadays. So I would imagine that might play into it too.
One could argue the environment is just completely different than it was 30 years ago.
That's true.
With or without social media.
When you have a lot less active, you've got more indexing. That may be a factor there as well, because again, when you put $1 in an index, you're putting $1, market cap weighted into all these different stocks, and quality, non-quality, you're not really differentiating. So I could see that playing a role too. But that's interesting. What else are you seeing in the hedge fund space?
Well, I think that this won't come as a surprise. Hedge funds generally are focused around risk-adjusted returns. And with volatility being where it has been, we've seen some positive performance, which is great from an investor perspective. I think that as you look at and some of the things that you talked about in terms of where we're expecting volatility to kind of continue at higher levels, I think anyone that is looking at risk-adjusted returns is in an environment that is healthy for some positive returns, including hedge funds. The other thing that we're seeing kind of across our clients, so positive performance has been really great. The other thing we're seeing is just around leverage. So no surprise, hedge funds use leverage as just part of how they manage their portfolios. We're certainly seeing elevated levels of leverage, and I think that's been fairly widely reported over the course of the past 6 months or so, let's say. So, just that continued view around looking for opportunities in the market. And I think that increased use of leverage is just kind of display of the opportunities that are available in the market to funds. And then I think we talked about this a little bit when we were here in July, but we really have clients that are just looking at how they can attract capital, retain that capital. And some of that has played itself out into looking at fund structures and kind of different fund vehicles, but also fee structures, right? We're kind of in this environment of 2 and 20 and have been forever. And that may not continue to be the case indefinitely. So really kind of that view of what's the capital that we can pull into funds and how can we deploy that capital, but also how can we make it sticky and look at where we're competing against the S&P and what have you, and making hedge funds kind of a little bit more competitive when you're thinking about not just the risk-adjusted returns, but returns in general.
That's interesting. The leverage point you brought up is very fascinating because, again, looking at the retail investor space, leverage is actually relatively low. Another sign I look at when you start to see, so I'm looking at margin debt, right, at retail brokerage houses, it's up, but it's not historically high, and it's certainly not high relative to where we are in this bull cycle. When you get to that really high leverage for retail investors, they're taking a lot of margin. Again, it starts to mean that the bull market's getting long in the tooth. We're not there. So it's interesting that the hedge funds are playing the leverage a little bit more, and the retail investors actually right now are a little bit less levered.
Yeah. So just as we look to close out, and we're heading into the fourth quarter here very soon, another year flying by very quickly. We talked a lot about U.S. elections, so I'm sure that's something to continue to keep an eye on in terms of where things go on the election results, but also the impact that they might have on the markets. Are there any other factors that you're looking at, or things that you're really, whether it's concerned about or even enthusiastic about or optimistic about as we head into the fourth quarter?
Maybe a couple things I'll just leave for the audience to think about. I mentioned gold. So gold has the opposite September effect. Usually gold performs very well in September. I'll be curious to see how that plays out. It's hard to tell who's buying gold kind of in the middle of the month. You have to wait till after, and you can get some reporting from the World Gold Council on who was the buyers, the gold was trending. But I think that's interesting to see how that played out because, again, we talked about the polarization and de-dollarization and everything else. That's a really good way to gauge it. But also, gold is a really good indicator on the health of emerging markets. So emerging markets seem to be coming around quite a bit right now, and I think there's some opportunities potentially there for emerging markets to break out. It hasn't been a great asset class for a period of time. Speaking of breakouts, the other area that I really want investors to look at is you've got a number of catalysts right now in the market that could mean we've got a secular shift unfolding. And I've talked about this in prior podcasts. You tend to have these roughly 30-year periods of secular shift. And they're almost uncanny. I've got graphics on this if folks want to see this later. And it's on the webinar, actually. I include this in my webinar on the election. So if folks can join in on our October webinar, I can actually graphically show this, that we have been in a period of the last roughly 15 years since the financial crisis where large caps outperform small. U.S. equities have outperformed non-U.S. I think U.S. equities now are 65% of global market cap. No sane investor should be thinking that the U.S. is going to be 65% of free cash flow returns over the next 10 years in the market. It's almost mathematically impossible. So, you would expect non-U.S. stocks to perform relatively better at some point. Some reversion to the mean there. And then you've got value has not performed well. It's been a growth market. And even the commodity cycle's down. Those actually, all four of those tend to go lockstep if you look historically. And we're at a 15-year trough of those. So what might flip that? Well, you've got two presidents that have been, especially Donald Trump, have been our presidential candidates, especially Donald Trump, who have essentially said they want a weaker dollar. And you're probably going to have a weaker dollar when we start cutting rates. People start to pull their money out. So that might pivot from non-U.S.
Should have done that European vacation this summer, huh?
Yep.
Messed
or
up.
You should have gone to Japan before July. So you could see, I think, some weakening dollar. I think you could see when the dollar weakens, it's going to erode the local returns for investors. They might start to put money back in their markets or other markets. I think you've already seen a bit of pivot in tech, right? We've already had the Mag 7, at least for the time being, have sort of hit a high, and the rest of the market's coming around. Again, another good bullish sign. I can point to a lot of good bullish signs here. Good breadth in the market now, picking up where the Mag 7 kind of left off. But if that trade breaks down, might there be more people flowing out? Might the pivot and go more to a value kind of view? And then I think commodities. I mean, they've had a really bad run for a while. They're starting to bottom out, it looks like. I think you could see a bit of a commodity run. The interesting thing about commodities is almost all commodities are dominated by a few markets that are producing those commodities. So, and it takes a long time to bring some of these mines on for some of these materials and minerals that we need to grow our economies and to also put in renewable energy sources as well. So I think, we're getting close to where this cycle pivots. It's always easy to see after the fact. So that's why I really want to encourage listeners to be looking for signs and to rethink their own allocation, because it's a matter, everything reverts to the mean. Value can't keep underperforming growth in the way it has to the end of time. It's going to eventually revert. When it does, it's going to have big impacts on portfolios. And so that's really what I want people to start looking for. Just so many things going on right now in the world that could mean that we've got this pivot.
Well, Grant, thank you so much for your
you.
time today. Thank you for all of your insights.
Thanks for joining me, Nadia.
Incredibly informative, as always. And as always, a big thanks to our listeners. See you for the next edition of Market Pulse, brought to you by Faster Forward.